Hi, I'm Sophia Song, Head of Research at StreetEasy. We've just released our fourth quarter market report, and we're here today to talk about recent trends in the new development market with Nancy Pax, a local real estate authority and consultant to some of the city's most prominent residential real estate developers. So thank you so much for joining us today, Nancy. We're excited to hear about your insight about what went on in new devs this past year and what's in the pipeline for 2013. Over the past year, we've heard from real estate agents, developers, and real estate professionals that there's very, very little new product out there right now. And there's still a big demand for new development properties. And just this past quarter, our report showed that while co-op and condo resale closings were up 42% and 52% respectively, new development closings were actually down by 28%. So from your recent experience, what have you seen in the supply and demand for new developments?
In the market last year, we had two types of new development. The projects that came to the market in 2011 and 2012, post the last cycle, and the product that was left over from the last cycle, which continued to be absorbed and is still continuing to be absorbed even today. The new projects were in very, very tony neighborhoods at typically twice the price per square foot and twice the price of older developments. They were very well received by affluent domestic purchasers and foreign investors, and they were scooped up and were extremely successful. In 2013 and 2014, we have approximately 1,000 units a year, new condominium development coming into Manhattan. That compares with levels in 2006 and 2007 of 8,000 units a year. But of course, in those earlier years, it was condominium product directed to all segments of the market, entry level, middle of the market, and top of the market. So in a sense, we are producing only now to the high end of the market, but it still isn't enough to really meet the demand of the domestic and foreign investor purchaser.
So back during the boom, we had seen these monolithic projects, new development projects with 600 units, 500 units, and completely selling out. Do you think in this new market, we'll expect to see the same kinds of gargantuan projects, or do you think we'll see smaller scale, more boutique projects?
So far, the evidence is for smaller scale and more boutique projects for a couple of reasons. We are not building to the entry-level condominium buyer as we did during the last cycle. So that takes many, many units out of a project. We're really building to the larger purchaser. Secondly, condominium development is at best risky. One always has the cycle to contend with, and rental development doesn't have the same degree of risk. So banks and developers alike are tending to focus on very secure locations and smaller projects that they are certain can be absorbed with larger units. And so far, that's what we're seeing. We are not seeing a return to the pattern of development of the last cycle.
So more secure locations, does that mean we should expect to see new developments in more classic Tony neighborhoods like the Upper East Side, Gramercy, as opposed to the outer boroughs?
Yes, I think you're absolutely right. What we're seeing is, whereas in the last cycle we had a great deal of new condominium development in Queens and in Brooklyn, rental prices in the outer boroughs have risen to the point today where a developer can have a very successful rental project with virtually no risk because those areas are beginning to gentrify. Prices are only going up, and there's much less risk. A developer has almost no motivation to risk condominium development in the outer boroughs unless it's in a very, very good location in the outer boroughs, like on the waterfront, where you cannot replicate the land and you can optimize condo pricing.
Thanks so much for watching, and be sure to check back for the next video on our fourth quarter market report, where we discuss luxury rentals with Nancy Pax.